This video will provide a solution walkthrough to exercise 6-8, which focuses on inventory cost flows under the first in, first out, or FIFO method. Here's the data for our problem. Sagur Limited operates a small retail store that sells some guitars and other musical accessories, and during the month of May, the following transactions had occurred. We have opening inventory on May 1st, 8 units at $550. Then, during the month, there are 3 purchases on May 5th, 8th, and 22nd for 50 units, 10 units, and 12 units respectively at different prices, $560, $575, and $572. Then, during the month, there are 2 sales, one on May 15th and another on May 25th for 15 units and 23 units respectively. And then the ending inventory is 42 units. Note, this question does tell you what the ending inventory is. However, most questions won't tell you that and require you to use the information that you have to confirm the ending inventory of 42 units. Our requirement is to use the FIFO cost flow assumption, assuming a perpetual inventory system, and to calculate the cost of goods for the month of May and the inventory balance on May 31st. Now, there's more than one way to approach these kinds of problems depending on your comfort level, but the easiest way is to set up a table to be able to track all of the purchases and sales. And our table typically includes columns for the date, purchase, sale, and balances. So on May 1st, we had 8 units in inventory that had a cost associated with them of $550. So that means the dollar value of the 8 units in inventory is $4,400. Then chronologically, the first event happens on May 5th, which is a purchase of 50 units at $560. This means that we now have 58 units, so the original 8 units plus another 50 units, for a total value of $32,400. And that's calculated as the beginning balance of $4,400 plus the 50 units times $560. Then on May 8th, there is another purchase of 10 units at $575. So our inventory now consists of a total of 68 units, 8 units at $550, plus 50 units at $560, plus 10 units at $575 for $38,150. You could have also just taken the $32,400 from the previous balance and then add 10 units times $575. You can do that because there are no sales. Then on May 15th, we have a sale. Now we have to be very careful about how we assign the costs of those units. So the first 8 units comes from the beginning inventory balance at $550. So that's $4,400. And the next 7 units comes from the next batch of inventory that was purchased at $560. So the cost of goods sold on that day is $8,320. This leaves us with 53 units in inventory, 68 units minus 15, and that consists of the remaining 43 units from the batch of inventory that was purchased on May 6th at $560, plus all 10 units from the batch that was purchased on May 8th at $575. So that's a total inventory value of $29,830. Then the company on May 22nd purchases 12 more units at $572. So the balance now is at $29,830 at May 15th, plus 12 units times $572 for a total of $36,694, leaving us with a total of 65 units. Then on May 25th, we have another sale of 23 units, all of which would have come from the existing batch of inventory that was purchased on May 5th at $560. Because there's 43 of those that remain after the last sale. So the total cost of goods is $12,880. This leaves us with 42 units in inventory, consisting of 20 units from the batch that was purchased on May 5th at $560, plus all 10 from the batch that was purchased on May 8th at $575, plus all 12 of the units that were purchased on May 22nd at $572. So it's a total inventory value of $23,814. What we can also do with this table is now sum up our purchases and sales. So when we take the number of units purchased times the purchase price, the total purchases in May were $40,614, and the total cost of goods in May is $21,200. We can use this information to prove the balances in our ending inventory. If we started with 8 units to begin with and purchased 72 during the month and sold 38, we should end up with 42 units in inventory, which is what we have. And this is why the data doesn't have to provide you with this number. We can also prove the dollar values as the $4,400 in beginning inventory, plus $40,614 in purchases, minus $21,200 in cost of goods sold, leaves an ending balance in inventory of $23,814. We can also manipulate the cost formula to figure out the cost of goods sold based on the ending inventory. So $4,400 beginning inventory plus $40,614 in purchases minus $23,814 ending confirms our cost of goods sold of $21,200. So we know we've done this right. There's also a little trick we can apply with FIFO to make a question like this a little bit quicker to solve if we only need to determine the total cost of goods sold in the period. And to do that, we can work backwards to determine the ending inventory, then figure out the cost of goods sold. So rather than working from the top down, we start building our inventory based on the most recent purchases. So we have a total of 42 units. The first 12 would come from the inventory at $572. The next 10 would come from the inventory purchase at $575. So that's a total of 22 units, which means the remaining 20 units would have a cost of $560 attached to them. So 12 at $572 plus 10 at $575 plus 20 at $560 equals a $23,814 ending inventory balance. Then we could just determine the total cost of goods sold by taking the $4,400 beginning inventory plus the $40,614 of purchases minus the $23,814 ending balance to give us the total cost of goods sold of $21,200. If we needed to determine what the cost of goods sold was on each of the individual days of sale, then this wouldn't work, and we'd have to work from the top down as we did originally. And that's it. The problem is solved.